So how do traders make money? Talk about Forex first. So in Forex, we have what is called a lot size. This is also known as a position size. We have three different measurements of the lot sizes. We have micro lots, which is zero point zero 0.01, mini lots, which is 0.10, and standard lots, which is 1.00. Now the micro lot goes from zero point zero 0.01 all the way to 0.09. The moment it becomes a 0.10, those are mini lots. And the mini lots go from 0.11, 0.12, 0.13, 0.10, all the way to 0.99. The moment that it becomes 1.00, that is what we call a standard lot. The highest lot size you can do, and those are one lot, two lot. You can go to 5, 15, 25, 50 lots, 100 lots at some brokers. Okay. These are the position sizes, the lot sizes. It's very versatile when you're trying to get the exact amount you want to risk. Now that we understand the lot sizes, we must understand the true value of these lot sizes, true lot size value. So to get the true value of your position size, we must multiply by 10. A zero point zero 0.01, which is a micro lot, you have to multiply this by 10 to get the real value, which is 10 cents. Because you take the zero point zero 0.01, multiply it by 10, and you get the real true value. This is happening for every lot size. For a mini lot, you got a 0.10. Times that by 10, that would be $1. And for a standard lot, this is 1.00 times it by 10, and that is $10. So the true value of these position sizes is always multiplied by 10. So although it looks like a penny, it's not really worth a penny. It's worth a dime. It looks like 10 cents, it's not really worth 10 cents. It's worth $1. It looks like $1, it's not really worth $1, it's worth $10. Everything has to be multiplied by 10 to understand that true value of your position size. Now that we understand the true value of our position size, we need to understand pips. So what are pips? Well, a pip is a unit of measurement used to track price, the distance that price has moved. Football field moves in yards, price moves in pips. For every pip price moves, you have to multiply the true value of your position size. This gives you the true value of your trade, whether it's a profit or a loss. So lot size times pip count equals your profit or your loss. All right. So if you took a trade with a two lot position, two standard lots, and you got 20 pips, how much would you make if you made the profit? Okay. So you're going to take this two standard lot, and we know we have to multiply this by 10. So 2 times 10 equals $20, meaning that this standard lot position size is $20 per pip. Take the $20, bring it down. 20 times 20 pips equals $400. All you did was bring it down the standard lots and multiply it by 10. Now, when you're trading, do you have to do this? No, it's automatically done, but it just lets you know so you can understand the inner workings of how the profit is made or the loss. So let's do another example. Lot size times pip count equals profit. If you do a 0.20 mini and you get 20 pips, well, what would your profit be? Well, you take that 0.20 and you times it by 10, and that lets you understand that your zero point 0.2 mini lot is now $2 in value per pip. And if you gain 20 pips, you made $40. You bring this down here, found out the real true value. Now we know we're making $40 if we get 20 pips on that lot size. One more example, we're gonna do lot size times pip count equal profit. So if you use a 10 standard lots times 20 pips, what would your profit be? So 10 standard lots multiplied by 10 means you're looking at $100 per pip. This is the true value of your position size. You take this down, $100 times 20 equals $2,000. All you did was bring this down, times it by 10, get the true value. Let's look at this chart here. If you click this ruler, you're going to end up with a unit of measurement that measures the move. So if you click from this bottom all the way up to this area, you will see that this 70.1. This means price moved a distance of 70 pips. Okay, you can do the same thing to the bottom and say, I want to measure that move. That's 19 pips. So wherever you take this ruler at and you click it from this point, you go all the way down to this point, 76 pips. It's going to measure the pip count for you. That way it makes it a little easier for you to understand. Risk reward. Let's understand risk reward briefly. We got to take profit and we got to stop loss. Okay. Risk reward is how much money you win compared to how much money you lose. You want to risk at least 1-to-1, meaning if you risk $100, you make $100. At least that's what you want to be risking. So if you look at this diagram to the left, this is something that will be a position tool. You can see that the red represents stop loss. Your stop loss is how much you're risking in a trade. And the green is the take profit, which is how much your target is for the trade. If the market hits your take profit, you win a trade. If the market hits your stop loss, you lose a trade. Let's look at how that looks on the chart. So one of the key things you must know as a trader that if the market is going down, that means the market is selling. So if you want to take a sell position, that means you expect the market to go down. And if the market is going up, that means you want to take a buy position. So if you bought the market, that means you're saying that the market is going to go up. So let's just imagine that the market wants to sell. Like we're saying we want to take a sell trade. So if the market is going down like this, arrows down showing it's down, that is showing the market is going down. People would say this is a selling market. The market is selling off. Let's just say you say when the market comes back here, you're going to take a sell. This is that same risk reward tool. And we're going to put it exactly at your selling point. Let's say the market comes here. Once the market hits here, you are entered into a trade. Understand that this here, your risk is 5. Remember, 5 right there. So the same way you can measure it, the risk tool does it for you. There's your 5. Your reward is 10. So it's already done with the risk reward tool, meaning that this is 2 to 1. You're risking 5 to gain 10. Now, if the market goes here first, of course, that means you won that trade. If the market comes down here and then hits this, you lose the trade. There's no in the middle. You're either going to win or you're going to lose with a stop loss and then take profit, which I believe is a great way to trade. So on the flip side, if you wanted to buy this, if price comes back here and hits your stop loss first, you lose. If price hits this first, you win. Simple. But we want to know how much we're winning and how much we're losing. Let's get over to that. So now let's talk about account size. The amount of money you can risk is based off the account and amount of capital that you have. So let's move forward. The bigger your account size, the bigger your position size. The smaller your account size, the smaller your position size. So the less money you have in your account, the less money you could lose, meaning your profits will be smaller than a larger account for the same move. The more money you have in your account, the more money you can lose, meaning you can risk more per trade, meaning you can have bigger lot sizes. Now let's do an example with a 10K account, 25K account, and a $1,000 account. Industry standards, you want to be risking between 1 to 3% per trade. Max will be 5% if you're very confident on the setup. So let's look at the difference. If we risk 3% per account, if you risk 3% with the 1K account, the max you're going to risk is $30. If you're risking 3% on a 10K account, you're risking $300. And if you're risking 3% on a 25K account, your risk is $750 per trade. So what I want you to understand is this. We're risking 5 pips to gain 5 pips in this scenario. Now, if I have a 1K account, this 5 pips only can equal to max $30 because I'm risking 3%, which means I'll be risking $30 to gain $30. I know it's small, but stay with me. This same thing will be said for a 10K account. You are risking $300 to make $300. And you're risking $750 to make $750 when you're trading a 25K account because you're just risking 3% because the name of the game is risk management. Whoever manages risks the best stays in the game the longest, therefore they usually make the most money. Okay, let's just say this person with a 1K account actually took this trade. Now, we know they only going to risk $30. So what happens is what lot size times 5, because you're risking 5 pips, gives you $30? Well, that answer is 0.60. So 0.60 minis is going to be what gives us $30. So what is the math? 0.6 equals $6. $6 times 5 pips gives us $30 risk. Okay, that's a 3%. So that's how we determine how much we risk. And if you want to make it easier, there is a lot size calculator. Let's just say if you had $1,000 in here, you wanted to risk, just calculate this. $1,000 account balance. If you want to risk 3%, 5 pip stop loss, you will be using 0.6. Okay, that's the easy way, $30. Let's say you take a buy on this trade. Why is this a buy? Because we want the market to go up. Notice how the market never comes down here first and hits this level, but it hits this level first. If you have to move this over and see that this area was hit, target was achieved. So that would mean that this person with this size account actually made $222, only risking $30. That is a great risk to reward ratio. So if you take this measuring tool here and you click it from the moment you enter the trade to the moment it was filled, you can see that trade took about 3 hours and 15 minutes. So that made $222 in 3 hours and 15 minutes. Not bad. Now they take another trade, risking that same 5 pips, which means we still use the same 0.60. In 38 minutes, they hit their target. Here you go. So now they made $198. This is close to, well, not close to, this is over $400 a day for this particular trader. All right? Pretty good. Now let's go ahead and go up to the guy who has a 10K account. Well, with the same trade, because he has more, his 3% is larger. So if you take 6, let's go ahead and use the lot size calculator to make it easy for y'all. I don't want anyone discouraged by the math. You go ahead and calculate, boom, $300 risk is 6 standards. You see, 6 standards. So if you take that same 6 standards, which is $60 per pip, you hit 37 pips. He's made $2,220 in one trade in 3 hours and 15 minutes. The same exact move, but because this person has a bigger account size, they make more money. So the same person takes the same trade on his 10K account, and now they have, using the same position size, $1,980. So this person has made over $4,000. This is just one day. This is a period of 7 hours. This is a work shift. This person has made $4,000. Now let's look at the person with 25K in their account. Well, the person with 25K, they're using 15 lots. Now, why are they using 15 lots? To make it simpler for you, because that ends up 15 standards, right? 750. What's the 3% risk? This pink area must equal to 3%, which is 750. So in order for us to get to that number, we take 15 lots times 5, and that gives us the 750 risk. Now, this person took the same exact trade as the other two people, but on his first trade, he's made $5,550. So on the second trade, this person with a 25K account has made $4,950 for a total of over $10K for the day. So this is how people are making money, because this is just one day. Some people get impatient, and let's say a person with a 10K account say, you know what? I want to risk 7%. If you want to risk 7%, go ahead. This person risked 7%, so now he's risking $700. So the 10K account will be using 14 lots on that trade. So you can risk however much you want, but industry standard 1% to 3%. When you start getting up to 7%, 10%, and I'm gonna do a risk management video on that, you're gonna run into the losing streaks as a trader. And if you're risking 10% per trade, if you lose 10 trades in a row, which no trading system should, my personal perspective, you blew your account. The name of the game is account preservation. Protect your account, protect your capital, so your ass can keep trading. So now that we understand Forex's position sizes and how they make money, let's look at futures. Futures does not have lot sizes. We have what is called contract size. And I only trade gold, so I'll only be discussing gold. MGC is called the micro gold. That's the micro gold contract. One contract is worth $1 per tick. So if you use 5 contracts, that would be $5 per tick that you're making or losing. So on the flip side, we have GC. This is not the micro. This is the regular gold contract. One contract is worth $10 per tick. So if you use 5 contracts, that's $50 per tick. So ticks are the pips in futures, meaning that we're looking to measure in ticks in futures compared to Forex, which is looking to measure in pips. Now, let's say this person takes a trade. It's the GC contract. This is gold futures. The value of these contracts is $10 per tick. So if we take the same risk reward tool, we know that we're moving this is letting us know how much we're risking in ticks. So this is now 30 ticks. When you see 3.0, this number here represents 30 ticks. So if you use one contract on GC, you're risking 30 ticks, which equals $300. If you get 200 ticks, you have actually just gained $2,000, because your $10 or that one contract is worth $10 per tick. If you made 200, 200 times 10 equals 2K. Very simple math. Now, if we did one contract on MGC, caught the same similar move, then $1, because one contract is worth $1. You times that by 30, you've risked $30 to gain $200, because one tick is worth $1. You made 200 ticks. $1 times 200 equals 200. And that's how traders actually make their money. Now, if you don't understand what these rectangles are of different shapes, rectangles and squares that are blue and black on my screen, these are called candlesticks. And in the next video, I'll be explaining to you what candlesticks actually are and what they represent and how to read them.